I think most of us saw both these two problems. Let's see. The first one says, Mr. and Mrs. Ms. and Mr. Well Off have a combined gross income of $250,000. The question is, what's the max they should spend each month on a mortgage payment? Well, you had to dig in your textbook, and let's see, I think I'm open to that page. Yeah, it's page 553. It's where they talk about this. And what you learn is that, and these are general guidelines, that you should only pay 20% of your monthly gross for your mortgage. So if we want to know what's the maximum we should pay for our mortgage, we need to take our gross, and this is an annual gross. We need to find out what the monthly gross is, and then take 28% of it. So we can do that. 28% of, let's see, 250,000, but that's annual, so we're going to divide it by 12 because we want it to be monthly. And if we do that, we find out that the most we should be paying for our mortgage, 20% of our gross income, is $58.33. Some of you who may have recently gone through the home purchasing process know about this 28%. It's something your realtor asks you to find out whether you can qualify for purchasing an expensive home. It's what the bank calculates to determine whether they are going to lend you money. They don't want to give you more than 28% of your monthly gross. So that's the most we should pay on our mortgage each month. Simple enough. Next question. What's the max that this couple should spend each month on their total credit obligations? Now, what does that mean? Total credit obligations. Well, our mortgage is certainly a credit obligation, but we might have other things. We got credit cards. Boo. We bought that new furniture at the 0% interest. Boo. We have a car payment. Yeah, so we borrow money in other ways as well. And so it says your mortgage should be 28%, but the most you should spend on all your credit obligations combined should be 36% of your monthly gross. So we can do the same thing. We can take that 36% of 250,000, make it monthly, and that says combined all of my bills on credit should be no more than $7,500. All right, and the last one is the trickiest part. It says if this couple's monthly mortgage payment is only 50% of the max that they can afford, let's stop right there. It says their actual mortgage is 50% of the max they can afford. Well, we calculated the max they can afford in question 1. We said you should be able to pay 28% of your monthly gross. There's the max that they should pay, but it says they're only paying 50% of it. So let's calculate what their mortgage is. We can do that right now. Their mortgage is equal to 50% of the max that they can pay. Well, the max that they should be paying is $5,800. Well, their mortgage is only half that amount. Lucky them. Which means they're paying for their mortgage monthly $29.1667. Okay, now let's finish the problem. If the well-off's monthly mortgage payment is 50% of the max that they can afford, what is the max they should pay for all other debt? The max they should pay for all other debt. Well, we learned that they should be, all of their debt combined should be $7,500. We know that their mortgage is $29.16 of it. So in order to find out what amount they should be paying for all other debt, the credit cards, the auto loans, we should be able to take $7,500 and subtract the $29.16. take the total that they should be spending on credit, subtract out one chunk of it, the mortgage, and that leaves us the max they can pay for all other debts. So we can do that. Max for other debt is equal to 7,500 minus 2,916.67. And that means that they can pay those credit cards and that auto payment with up to 48, 45, 83, 33. That much per month. Now, these are rules of thumb that the bank uses. If you're not a big spender, you can probably have a mortgage that's 30, 35, maybe even 40% of your income. I've done that. We pinched pennies, but we wanted a nicer house when I was young. Got done with college, first job. But these are the numbers that the bank uses when they're deciding whether to loan you money. Okay, last problem. Oh, that's the tax table problem. Now, you were given some equations, and where you jump into this process is based on the problem. I've made this problem to be a pretty simple one. But you may have to make some of these calculations. You might have to calculate adjusted gross income, which is just the gross income minus adjustments. And what are adjustments? These are tax-deferred things. So how do we get tax-deferred things? Well, sometimes our 401k or our 403b or our IRA are called tax-deferred adjustments. We can take those right out of our gross on our income taxes. Sometimes the health insurance we pay can be tax-deferred, and we'll take that. That's an adjustment. So then we calculate adjusted gross income, but we still need to know what our taxable income is. So we take our adjusted gross and we subtract exemptions and deductions. Well, exemptions are, let's see, those are the things you get if you have 3 children, you get a certain amount of money. Those are exemptions. Am I remembering that right? Deductions, what are those? Oh, that's where we do the standard or the itemized deductions. Again, we're reducing our income, reducing our adjusted gross income. It's the amount that we're going to be taxed on. Finally, we can calculate our income tax using the tax computation. We take our taxable income and we use these rates here. And then we can subtract out any tax credits we may have. And I don't even recall what tax credits are. Maybe you made extra payments during the year towards taxes. I'm guessing. I don't know what other things these tax credits might be. Maybe our text tells us. So we need to calculate. What are we given here? It says use the 2012 tax table, and I've put a portion of it here. 2012 tax table to find the tax of a single person. Yep, I got the single column. I think you see more columns when you look in my math lab. With an income of $74,000 and a tax credit of $4,000. So we're going to have a tax credit down here of $4,000. But most of our work is going to doing this tax computation on their $74,000 taxable income. So it says, how do you calculate tax? First of all, your first $8,700 you pay 10%. So we can calculate what the tax is going to be. It's going to be 10% of 8,700 plus, let's see, 15% of all the money from 8,701 up to 35,350. Well, we're up at 7,400, so we're going to pay for all of that. 15%. And I think people get messed up on this one rate here. And this 651, what you have to do is this. Let's see, make sure I get it straight. You take the 35,350 and you don't subtract 8,701, you subtract 8,700. Yes, that's right. Otherwise, you're going to end up pennies off and you're going to be incorrect by MML. All right. So we also going to pay 20% of what? Let's see, our money from, not 20, 25%. 25% of everything from 35,350 up to, well, no, we don't go up to 85. We're at 74. So we'll take our 74,000 minus 35,350. Again, I didn't use the 351. I always used the 350. I didn't use the 8701. I always used 8700. Okay, so that's our amount of tax. And then we're going to do what? We're going to subtract off our credit of 4,000. So I made this calculation already, and I found that the sum of those taxes is 14,530. I'm going to subtract off the 4,000, and my income tax is 10,530.